Well, hello, welcome, and Christmas, New Year interregnum, and great to have you on. 28th of December. Can't believe that this year has already departed. I'm just going to put the pre-show banner on and to welcome a few people in the chat. Nice to see healthy turnout. I wondered who would be on tonight, given everything else that's going on. Vanessa, thanks for that, and many others as well. A few others. Master Singleton, I see. Cookie Boy. Lord Cookie Boy. He's elevating himself even more. I assume he will become omniscient and then become God eventually. Is that right, Cookie? That's your trajectory, it seems to me. Great to see everybody else. I did say earlier on, Doggy Cam is online. And in fact, there is Doggy Cam. There you go. So the dogs are very firmly asleep at the moment. And I don't know whether you saw, but we had Jill's final interview on Current Affair tonight, which is all right. I will just mention, before I get going, that on Thursday at 1:15, we're going to start streaming. It's actually in the diary, 1:30 on YouTube. We will be actually streaming a memorial and celebration event for Jill. And this will be my most complex production yet, with 3 different cameras, a live audience, Zoom coming in, as well as streaming direct to YouTube. So if you'd like to join in on that, the YouTube link is already up. So mark your diary on that. And without further ado, let me now get rid of the pre-show and let me start the intro, and then we'll come back and start the show properly. Hang on a moment. Well, good evening and welcome to this live stream event on the 28th of December 2021. Martin North from Digital Finance Analytics here. Great to have you with us between Christmas and New Year. Thank you very much for taking some time out on your Tuesday. Just before I bring Damien in, he's teed up and ready to come in, but I will just remind everybody, of course, this isn't legal or financial advice, general conversation only. Do play nice in the chat room, no racial slurs, please. This is as at the 28th, as I said. If you want to get my attention, use @Walk the World. I've also enabled Super Chat, which means that if you'd like to get your question to the top of the list, just use @Walk the World, or indeed if you'd like to make a donation either to the normal channel, Walk the World, or indeed to Asbestos Awareness Australia, and I'll talk about that in a moment or two. I've enabled Super Chat to enable that to happen, so I look forward to your conversation and participation in the chat. And I will now, hopefully, if I press this button here, Damien, are you there?
I am, Martin.
Eureka, it works.
Yes. Merry Christmas.
And to you too, and I hope you and your family is enjoying the bit of a break, the bit of relaxation.
We did. We had a week off last week, and then I'm going to have a bit of a break in the towards the end of January. So I'm doing the middle shift, so worked out well.
Excellent. Yes, I noticed that our next one won't be at the end of January, but it'll be the first week in February. Right? We kicked you forward a week to allow you to come back from leave and on your long run. So
it's assuming I'll get back into the state. That's always the question at the moment, isn't it? So.
Well, yeah, it does seem to be. There's a lot of shenanigans going on. A lot of people, stuck and can't get flights or can't get tested. Well, certainly. I think one of the thematics for tonight will be living in uncertainty, right? Because I have a feeling that 2022 is going to maintain its uncertain record.
Yeah, absolutely, and it's always preempting a little bit, but there's always this question about, when you've got so much uncertainty and you've got expensive markets, where do you find some, where can you put some money? So I guess we'll move into that as we go.
Well, I think it's a good question, and somebody is asking in the chat beforehand, is it even conceivable to invest at the moment? Bearing in mind where things are, and what about youngsters? Trying to save. Well, what can you tell them? Because there isn't many options really for youngsters. You put money in the bank and you lose real value, and it really is a tricky time.
Yeah, absolutely, and I think the thing we sort of harp on about is maintaining some sort of exposure and keeping that savings habit going in terms of making sure that you are using that power of compounding and just keep investing over the time and relying on the fact that you're going to get some of them, you'll never time it exactly right, and hopefully you'll never time it exactly wrong, and it's but if you've got that regular amount going in and just keeping that money ticking over, and a lot of that's the whole idea of superannuation in its own right, is that that money comes out of your salary, it goes into the market or into wherever, and just keeps popping up every every month or every couple of weeks, and that's really what that savings habit is what provides that return over the longer term. Trying to hold off on that and hold it back and pick the 27th of this month and then wait 3 months and then to put it in on the 3rd and all that type of stuff is a pretty tough way to try and make money from that.
Yeah, and I think those 2 points you just made are really important. One is the compounding. Right, and that's partly the compounding, because when you generate returns from stocks and you put them back in, it continues to grow. But also that stocks tend to grow because inflation tends to support stock growth. Right? Yeah,
absolutely, absolutely. Over the longer period of time, I think if you look through various asset classes, stocks do give you that good return because you've got the dividends coming in. You've got reinvestment going into the companies, and generally those profits keep growing, and so a lot of it is sort of getting onto that. The difference between that, say, and looking at something like the housing market is a good example. Is saying yes, rents do grow over time, but they tend not to grow as fast as what profits do. Profits tend to grow above inflation. Rents tend to grow at inflation or a little bit below inflation, depending upon the time frame you're taking and whether you're accounting for capital expenditure and other things properly. And then you look at things something like a foreign exchange, for example, and foreign exchange is literally just a zero-sum game. For every winner there's a loser. Well, even worse than a zero-sum game, because there's somebody sitting in the middle taking fees. And so, you can use those tactically, but in terms of foreign exchange positions over time, you'd expect that they sort of they'll just revert back to averages across all the currencies, because that's effectively all you're talking about. So it is that idea. You do want to have that strategic view of getting a decent hold in it, and we like to try and lean into the cycles a bit. But there's a big question about how far you want to lean. You don't want to lean so far that you can topple over in either the direction. You want to keep that. Even the last 12 months, we've been talking about that same story over and over again. We've been conservatively positioned, but our funds, our growth fund, for example, is outperformed over the last 12 months the median growth fund by 1 or 2%. Even though we've actually had a lot less equities because we're sort of playing around and trying to take some positions, but it is about trying to maintain at least some exposure to the market over that time.
Yeah, and I remember when we first announced the World Funds and the tie-up with Nucleus Wealth. I said at the time it seemed to me essential for people to consider seriously being in the market, right? And if you hadn't been in the market over that period of time, you would have missed out on a considerable upswing, right? And quite a consistent upswing. Now, whether it's permanent or not is a different question. But the point is, people will have made more by actually being in the market than out of it.
Yeah, that's right. And so I think there's certainly a case to be made for it. And in terms of whether is today the right day to dump your entire life savings into the market, I'd be
that's not what I'm saying.
No, that's not the case. But I speak to a lot of people about this same topic, and I've probably mentioned it on here before. But for what I tend to say when somebody comes to me and says, yes, okay, I know I should have been regularly investing, but I haven't been, and I'm sitting on whatever, $500,000, $1 million, and I haven't invested it. Is today the day I put the money in? I tend to say, well, especially at the moment, with markets sort of priced higher, I say what you really do need to come up with is a plan to invest it, whether it's over 12 months or 18 months or 6 months or whatever it is, and just say, okay, well, I've got 500,000 to invest. I'm going to invest 50,000 a month for the next 10 months is my base case. And then you can always, you don't have to do it, but as long as you've set it in that base case where you might have already set up the direct deposits or whatever, so that they're going to happen, and you have to go in and take it off if you really want to stop it. At least that way you end up in the position where you actually get invested. Yep. Whereas I think a lot of people's default is do nothing. And then they're sitting around 6 months later and they're like, oh, my default was do nothing, and I never actually got around to doing it. And life gets in the way, and there's always a reason not to. So whereas if you sort of try and preempt yourself and I guess make it, you don't have to follow through. You can always pull it back, but the idea that it's the default is trying to get invested over a period of time, I think works out quite well for most of our investors.
Absolutely. And I guess the point there is that it's very hard to pick the bottom and the top of any market, right? But if you're actually then, putting it into the market over a period of time, that actually often helps, doesn't it, to iron out some of the humps and bumps?
Yeah. So, I think the way the stats basically work is, because markets do rise over time, is the answer is, the statistical answer is yes, stick your money in as soon as possible, because if it's going to rise over time, odds are, tomorrow is going to be slightly higher than today, and so on. Having said that, though, markets obviously do go through big downturns and upturns, and I think what we find is most people want to try and minimise their regret in terms of they say, yes, I don't want to be the pain you're going to get from dumping all your money in today and finding the markets fall 20% is not as good as the pleasure you might get for trying to pick the bottom in 6 months' time or whatever, if you do have a pullback. And so so that idea that if you are just sort of gradually investing it, you'll feel bad that you put the first amount in at maybe at a higher amount, but the second amount you made a lot more, or vice versa, and so hopefully it all washes out, and you can feel good about what you're doing, rather than feeling bad about not picking the exact moment that everything bottomed or topped.
Yeah, that's right. And Vanessa was just saying, you got to think about risk, because if you don't take risk, you don't get returns. And I suppose that there is a risk-return question in there, isn't there? If you want to be absolutely safe and secure, then you might not get much, but you perhaps won't lose a lot. But on the other hand, there's some upside you might be missing.
Yeah, absolutely. And everyone's different, and it needs to be mapped back to your risk profile and to how much you have and how much you think you're going to need. So we've got a few tools that will help people through that. If you need some help, we can certainly jump on or we've got speak to financial advisors. We have some financial advisors who can help you with that chat. But anyway, let's get into the topics.
Yeah, absolutely. Just before we do that, let me just acknowledge Kieran asked me to turn you up a bit, so I have turned you up a bit. I was trying not to bring you in too hot, because last week I got a bit of complaint from a few people that we were getting a bit over the top, so I turned it back slightly. I may have overturned it down. So hopefully, guys, tell me whether you think the sound's now about right. But anyway, Damien, you've got some amazing slides to go through, so let me give you full screen, and then you can go and start on your journey of exploration with the slides.
Yeah, sure. So it was just really a couple of charts I wanted to talk around, and the idea was that let me just pull up this up. So I've got two different sets. So I sort of put them into I've just dumped them in so that hopefully we can see them without sort of doing full presentations. And because there's a website as well that I want to have a quick run through. So firstly, I just wanted to go through the inflation side. So we've obviously come along a few times and spoken about transient inflation, and the big change, I guess, or the changes since we last spoke, really are this idea that we're looking at extended periods of time on the supply side as Omicron's sort of driving things a bit further. There's energy issues and the energy certainly geopolitical issues that are going on there, and I want to sort of address that. And then finally, thirdly, I want to talk a little bit about China, and then finally, I want to talk about what's happening in terms of population growth and particularly household formation. And so I guess the way we're sort of looking at it is there's a couple of really big forces pulling in different directions at the moment. And so we're certainly looking at the inflation side going, look, we can see where this might last a fair bit longer than what we initially thought, particularly as supply chains are staying where they are, and supply chain issues are still going on. But we still think the overall ideas behind it is that there isn't actually a structural change within the production of a lot of these goods. A lot of it is excess demand and coupled with supply shutdowns and problems in the supply chain, is that both of those seem solvable, and so that that's where we see inflation it is coming back, but that it could last a fair bit longer, I guess, is where we're coming from. And so, I guess in terms of talking about that, though, I just wanted to put it into context. So I've got the slide I've got up here is just showing the G10 inflation, core inflation versus a year ago. And I've got that red line showing that 2% line. That tends to be the line that most countries sort of use as like their benchmark, as where they want to try and get inflation roughly to. So you can see that about half the G10 is still below it on the right hand side there. Sweden, Switzerland, Japan, Norway are all still running inflation rates quite considerably below that 2% level. You have the sort of three in the middle, the Euro, Australia, and Canada, that are sort of there and thereabouts. Maybe Canada's a little bit high, but they're sort of in that, roughly in that range. And also keeping in mind, I guess, that the Australian target is for 2.5%. And then we've got the three on the left there: New Zealand, the US, and UK, which are the ones where inflation is running hot. So I guess where I'm trying to get to is it isn't a global phenomenon. It is affecting, most of the world is looking at higher inflation this year than what they saw last year, but it's not like there's this wave of inflation running right across the world. It is nuanced where it is, and the fact that it's particularly high in the US in particular, I think sometimes overstates what's going on, because you get most of the news coming out of the US. And I think actually Ross Gittins even ran an article the other day, sort of talking about exactly that reflection in that a lot of Australia gets put into the whatever's happening in the US, therefore must be happening in Australia, without that sort of taking one step back and going, no, actually it's the rest of the world is different.
Let me just come in there a second, because it occurs to me that if that's true, and the Fed then reacts to the inflationary pressures in the US, that could have a very significant effect if, in fact, the inflationary pressures are a lot lower in other countries around the world.
Absolutely. And that's actually where we've been positioned for some sort of, we've been speaking every time about this, we're in the hands of the gods, not hands of the central banking gods, in terms of markets, given the amount of money they're pouring in, and governments, is we do think there's a mistake, potentially brewing within the US, and if they taper too quickly or start raising rates too quickly, we think that'll be a mistake, and that there will be a snapback. But when that snapback occurs, is hard to tell, and there's certainly lots of strident voices out there talking about how bad inflation is and how it's been high for 6 months now, and so therefore, it must be, therefore it's going to be high for the foreseeable future, and so they've got to get out and do something about it. And so that's that's our biggest what we're positioned for, I guess, is a mistake on that front, and with a view that if that happens, then we're in sort of buying equities, and that would be enough to send bond yields down, equities down as well, and because bond yields themselves are falling, means the value goes up, and then you're sort of switching out of bonds and back into equities. And so we've had a bit of the bond side already come through, but the equity side, every time we think it's pulling back, it then goes and adds another few percent, and it's hard to see where the end of that is. Okay, so that was that side. The other thing really to note is that, and I think I've spoken as well on here a few times about this elevated goods demand. I thought this was a fascinating chart from Goldman Sachs again, which is just sort of showing that we've got this red line, which is the US goods demand, and you can see there was this trend line sort of running up the dotted red line, and then it's really taken off above that line. So the idea that there's all this extra goods demand in the US. Now the blue line is basically the OECD, so that's the developed countries, excluding the US, and that's showing that that on that front, actually goods is running roughly at trend. It dropped below trend, but it's actually pretty much running at trend, and it's only that the US has sort of been carrying you above that in terms of that. So again, it's that idea that it's not a global phenomenon. So US is certainly very big and very important. You can't sort of just ignore it, but this isn't an event that's going on and affecting everyone in the same way. Then if you tie that back, I've got this scatter plot chart sort of just showing, what this is showing is that you trend above GDP. The trend above what you were on for your goods expenditure, and then the difference in goods prices changed from January 2020, and you can see again that's at it's a pretty decent correlation between the two in terms of saying if you're spending lots on goods like the US, then you're getting lots of inflation, and if you're not spending lots on goods like say Japan or Ireland or France, then you're just not getting that same level of goods inflation coming through. So that's one part. Then the wages side, because that's obviously a big issue as well. That's the part where the idea that the dangerous type of inflation that you worry about is inflation where inflation goes up, therefore wages go up, and therefore the goods go up again in price to cover for the rise of wage, and then wages need to go, and you get this spiral upwards of wage cost push inflation, as they call it. So, and that's that. We can't rule that out. Certainly, the US inflation wages are running quite strong. Having said that, though, again, you look at the euro and Australia, and you can see that actually wages are running pretty weak in both those areas. I think if you look at the US as well, it is at the lower end, which is sort of a positive thing. So it is a lot of the it's a lot of that issues about inequality we spoke about. So if you're giving pay rises more so to the person who was earning, $12 an hour and now they're getting 15, or 15 and now they're getting 18, actually they're probably getting out and spending most of that money. And I think that's probably what's then reflected back in that whole goods demand. And so there's a little bit of a you can sort of see in the US where you can paint a picture of that happening, and then jumping in with this the next chart, which I'm going to show you, which is the growth in households, and you can paint a picture of sustainable inflation going on from there, and that's where actually I think I'm jumping around a little bit too fast on these ones. Is there any other questions? Anything else on that inflation before I jump into the households?
Well, let me just pick up one point there, because obviously one of the questions is the inflation being driven by wages, or is the inflation being driven by the supply chain disruption and all the goods, right? And if in fact the demand is goods, that is not necessarily linked to wages in the same way as, if people are actually getting significant wages rises. Now in the US, we know that in some areas wages have actually significantly started to go up. In Australia, not so much. And of course, Lowe is basically saying he doesn't think there's going to be much wages action until the unemployment rate continues to fall. And then, of course, the government says, well, we're going to have to open up the gates and bring migration up because we need more people. And of course, as soon as you do that, the RBA also made the point that actually higher migration depresses wages. So it shows you that maybe in Australia, the chances of getting significant wages momentum and therefore inflation driven by wages is probably quite low.
Yeah, absolutely. Look, I think on the wages front as well, there's this issue about structural changes in economies, and I'm gonna I guess I'm floating these out here is more of these big sort of tectonic forces that are affecting economies at the moment that I'm not quite sure which way it goes, but there's a reasonable case in terms of that. Let's say the US is, there's a bunch of people employed in services, but pre-COVID, and you're a waiter and you lose your job when COVID hits, and you can now get a job in an Amazon warehouse packing because there's all this extra goods demand. But you're not actually looking for ads for that at the moment. You're out looking for ads for waiting jobs because that's what you are. And then it takes you a while before you sort of go, okay, there's nothing going on in that front. And then I wonder what else I might do. There's an ad for to pack shells and then you move into doing that. And so maybe they actually need to put the wages up a little bit in order to get you across and sort of get get that structural change happening within the economy. But then the flip side happens then again when the reopening happens and all these restaurants turn around and go, oh, okay, now I'm ready. Where are my waiters gone? and you're not looking for waiting jobs anymore. You're now packing stores, and if you're thinking about changing jobs, maybe that's where you're looking for jobs. And so maybe to get you back to doing a waiter job, the wages need to go up again. And so so if that's the case, there's sort of this structural issue that we may not have seen the end of yet within the US. So that's one sort of glass half full type look at it. And the glass half empty one is, no, there was all this money thrown at US guys, people in the US, and particularly in the way of stimulus checks, and they all rushed out and spent that money, and therefore made this extra demand for goods. And so then you needed to, you got shortages of goods, and then so you needed extra employees, and because those extra employees came on, they then went out and spent that money as well because they got the pay rises, and so then they often bought goods as well. And so this was sort of this one-off effect, and you're getting the echoes of it where the spending's happening, but the impetus was there's this huge transfer from governments across to people, and as that echo gradually fades, there's not a lot of real demand behind it to actually fill in the gaps, and so then you'll see the wages come off the other side. And so I can't tell you which one of those is true, but I can see that there's a reasonable story in both, and as potentially they're both true in just in different industries. And then how does it flow through to the end result? Is more difficult again. Which of them is more powerful and which of them isn't. So,
but the point is those end game states on those two scenarios will be quite different, wouldn't they? So
absolutely,
it's almost a magnifying impact, but in one of two directions. So it goes back to this uncertainty thing that I started with. If you follow those lines of argument, then the two outcomes are a long way apart.
They are, and then the flip side is though, and that's probably a good entree into the next one, is that there's another big factor that I think's helping to drive this as well, is this idea about, and it's all about this structural change idea, is that if we've got structural change in actually the number of people living in houses. And so it's the idea that, pre-COVID, people were happy to have, a number of flatmates and a certain number of, they didn't need to study because they went to work 5 days a week, and they're happy to live with, 4 other people, and then viruses happen and things like that. And they're like, well, maybe the fewer people I can live with, the better. Or now I'm going to be working from home 3 days a week or 4 days a week, so I actually need a bigger house, or I need one fewer flatmate or two. And so the idea that you actually get an increase in the number of households, driven by fewer people per household, and that's got its own sort of cyclical driver to it as well. In that's you get a new household, you need new tables and chairs and couches and TVs and whatever it is as you start up those as that new household is formed. And so if that's the case, then there's a couple of years of that that could easily drive the markets. And then you have that same structural issue of people don't want to live in apartments as much, and they want to live more in houses. And that's going to make structural change in terms of pushing house prices up, while then we go out and try and build a whole bunch more houses to fit for the demand that's coming through. And then that's pushing the because there's all this extra demand, that's pushing up the prices of the building materials. And then eventually that demand sort of slows down and slacks off. So that's sort of one part to it, is that there's a structural long-term increase or decrease in the number of people living in per household. And the flip side goes to that is, well, maybe that's just because interest rates have fallen so much so. And so, people will live where they can afford. And if they can afford, if interest rates have fallen, and if they can afford to get something bigger or more rooms, they will. But interest rates are pretty close to the bottom and starting to edge up. And so maybe that's going to go into reverse as people, you're going to get less household formation because household prices have all jumped 20-30%. And yes, the affordability came back because interest rates fell, but now interest rates are going the other way. The affordability is no longer there. And so maybe all that household growth goes back into reverse. And so, and that then maps up to the prior stuff we were talking about in terms of the wage growth. And it's not necessarily that it'll be, up and up, or it might be. You might see the double up or the double down, or you get one positive on one and negative on the other, and so there's a whole bunch of different permutations and combinations about where you can see this coming out, and I think a lot of it is behavioural now. Is how will human beings react to this? Will it be that let's say paint the scenario where Omicron is much milder, which it seems at the moment. It rips through populations, which it seems to, it looks like it's gone through South Africa twice as fast as it went through, as Delta did. Let's say it rips through populations in a similar way, and in 6 months' time, everyone's sort of talking about, it's all over, and let's get back on with life and go on to do other things. Or maybe it's just the start of another. Maybe it's got a later kicker, and it does make things worse, or there's new variants to come, and people have structurally changed the way they're going to deal with this forever. And so, I've got my own views about which way it is, but they're not particularly strong, I think, in terms I can see a good scenario, a good argument for both cases. And so we're sort of trying to position our portfolio really around, what's been priced in, what do we think the market's pricing? And if the market's pricing too much of one thing and or not enough of another outcome, then we're sort of trying to switch and take advantage of those. But it really is about, I think not being sort of too dogmatic about saying this is exactly the way things are happening at the moment, and sort of taking your whole portfolio and assuming you're going to be 100% right and putting it all on a single outcome.
Right, but that's interesting, because what that means is that when you're actually thinking about asset allocation and portfolio adjustments, it's not just what upside is there, but also what is the downside risk if it goes wrong, right? Because it's almost, if it goes wrong, what do I do? That becomes almost as important, or perhaps even more important than the upside opportunity.
Yeah, absolutely. I'd very much side on the more important. And I take some of the bond trades where it's sort of starting to your bond yields have fallen back a bit. But that's a good example of where we look upon that trade, or when we sort of got into it sort of 3 or 4 months ago, at sort of much higher interest rates, and as interest rates, well, not much higher, but relative to where the movements are, they're closer to the bond yields were sort of 1.8% ish, and been coming down. And so the idea is that from that is we couldn't see a lot of downside to that trade, in that if the rates rose particularly quickly, then that's actually going to stifle the growth itself. So there's a part about people saying, bond yields going back to if they go back to their long-term averages of 4 and 5%. Well, if they go back to 4 and 5%, that's going to kill every economy globally, stone dead. So that's one where I can see a certain amount of upside, and I can see the downside. I don't believe the really extreme cases. Whereas on the equities side, it can be different in terms of looking at particularly some markets, China in particular, and going, okay, where do we see the downside in that? Actually, we can see the downsides a lot further. And if they're basically trying to hold that market up, and particularly the property sector, they're really just trying to hold things going, and sort of glide that property sector down. They could get the calculation wrong, and you could see significantly more downside. And so that's a market where we'd be much more concerned about saying, taking the upside risk for because there is that much downside. And so so very much we spend a lot of time doing what are the upside downsides, and then just trying to work on the probabilities around that, and what we think the probabilities are, and versus what we think is being priced in by the market, because that's the net effect of where you can. I think it's I don't want to call it like horse racing, because it's not. I think I like to think it's a lot more steady than that, but it's being more like a bookie in terms of saying, okay, I think this horse is the favourite to win, but if the pricing comes down so that it's priced as a 99.9% chance of winning, okay, I'm going to start looking at getting into something else, because I think it's it might have a 90% chance, or it might have an 80% chance of winning, but I don't think it's 99.9% chance of winning.
Well, what's interesting about that is the intersection of the macroeconomics and those broader thematics that we're touching on. compared with price earnings and looking at different types of stocks and different sectors of the market, and this is a much more complex philosophical way of thinking about the market, isn't it?
Yeah, very much. And for me, it's all about trying to lean into the cycles, saying yes, we're not going to bet extreme on any case, but we certainly will try and take the mispricings where we can and drift into other ones. So another good example is the resources sector. So at sort of iron ore prices and Australia, a lot of Australian is all based off iron ore, but we're looking at that Chinese property market, and it's every second or third day you're seeing another company over there defaulting, and another developer that sort of can't meet its bond payments, and they're certainly not opening up in terms of Chinese authorities. They're not bailing these things out. They're trying to keep them going in terms of they're trying not to go into this huge debt default issue, but they are trying to let the shareholders and the bondholders wear the pain. In particular, the foreign shareholders and foreign bondholders wear the pain of making the investment, and so that's where we just look at that falling back, and we look at the iron ore. We looked at the iron ore price of $200 and said nope, that's coming down and quite significantly. We think it's headed back probably towards close to 50, but it's not a straight line. It's gone back to, I think it probably bottomed out at 70 or 80 and then back over 100 again as people get excited. And it's just an area where, again, we're sort of trying to say we're not quite sure exactly where it'll settle, but we know it's going to be a lot lower than this if China keeps going the way they're going. And they're certainly not making any signs that they're going to get out and try and reignite a property bubble. Maybe they will at some stage, but we think that's they'll at least go through a 2015 style slowdown, and that's got a lot further to fall. And so, given the price, the way those stocks are priced, there looks like there's more downside, and so looking to move into other sectors of the Aussie market.
Fascinating. And going back to the earlier point about the fact that inflation is different in different countries, and thinking about geographic overlays as well. Is the US better than Europe or Australia? Right, that's another overlay to think about too.
Yeah, absolutely. And when you're investing in these markets, the S&P 500 is very, very global now. So it is worth just trying to work out as well what you're investing in. So we find there's, and it's something we've been doing for the last 3 or 4 years, is looking for stocks that have got lots of exposure to the US, where we see the most growth, but listed in other countries, because you can usually pick them up for much, much cheaper. And often you can pick them up, in countries where at sort of I don't know, maybe 30% cheaper than what you might find the equivalent US stock for. And so it's a matter of saying, well, just because a stock is listed in a particular country doesn't mean that's actually where it's where most of its business is. And so you see those very much on the ASX as well. So I mean, BHP or Rio is not it's not an Australian stock in our view. It's got Australian costs, but it's really tied to the global market, and in particular the Chinese housing market. If you look at something like a CSL or a Brambles, they're not particularly Australian stocks. Yeah, they've got a reasonable amount of costs in Australia, but actually these are global stocks with global markets, and so it's actually more about what's going on offshore than what it is about what's happening in the Australian market for those guys.
Yeah, interesting. And Jason, thank you very much for that super chat. Really appreciate that. And gosh, yeah, I every time I talk to you, I get reawakened by the complexity of this whole this whole machine. It begs the question: does anybody really understand what's going on?
There's plenty of people who think they do. And
yes.
I like to think. Sometimes I probably fall onto the case of being too optimistic about views, but I think the idea that you think of it very much in a probability sense, and what's priced into the market is I think the right way to look at it, because it's when the market gets when the market starts pricing in a particular outcome that isn't that likely, that's where it gets surprised and falls back. When if it's coming through and getting the types of results it was expecting, that you don't get a lot of movement in the market. It's where the market is expecting one thing and then getting something quite different. That's where you usually get the biggest sort of price changes. Okay, so I'll hit on two other quick ones, and then China was the other one. I haven't got a lot of charts ready for China, but let's talk about China as well. But firstly, let's go the supply chain. So I must admit, I was hoping to see a lot more movement on this. I think some of it's probably Omicron in terms of shutdowns you've seen, and actually, I should explain. Let me explain this chart first. I mean, this is just one of many charts out there, but sort of showing the problems in the supply chains. But this is container ships waiting off LA, and the blue line was the one everyone was sort of focused on, and you can see it's had this big fall recently. But all that's happened is actually they've just what you used to have to do was you used to have to go full steam ahead at the to LA. As soon as you got there, you threw your anchor out, and then you're in the queue to get into the port. Whereas now they're actually letting, they're actually getting ships much earlier. So they're saying, okay, you've just left China. There's already a big queue. Don't go full steam ahead. We'll reserve your spot on the line.
Go slow.
Exactly. You can just float across the ocean, and then at least you're not just sort of sitting there anchored, sort of waiting for it. And so if you take into account that, it's still getting worse. So, there is some hope that, and they are running at reasonable levels and doing lots of overtime and all that type of stuff. But Omicron's going nuts in the US, as in many places, and so that's sort of cutting back on people's shifts. I think you'll probably see, another couple of months of this. I think it is worth noting that, so in terms of peak cases in South Africa, we saw it was basically the delta was about 2 months from when it sort of really kicked off to when it peaked, whereas in the Omicron it was less than a month, so it was less, basically less than half to where the cases peaked. I mean, they obviously shot up quite dramatically, and it looks like that's what's happening in the US at the moment. So. And it's obviously happening in Australia as well. So, but I guess it is worth noting it could all be over a lot faster in terms of that side. But I think there's still, we're obviously not clearing because the ships that left the say China, at the 1st of December, they were never going to make it in time to get the goods out for Christmas. So there is that whole. I think there's a lot of different things that have gone into this supply chain issues, and as you hear about it, a lot of these ships that you can see here aren't actually even full, because what was happening was they were sitting at dock, and the ships are really expensive at the moment. They're sitting at dock waiting to fill up, and people would go, well, at $2,000, I was happy to do it, but at $10,000, I don't want to do it. So I'm not actually going to put I'm not going to send you my container. And so the ship's sitting there going, well, do I wait around for another container, or do I just get going? And with the cost of the ships, they just got going. And so and then there's a question about how many people have double ordered from 2 or 3 places to try and fill their own inventory. And so so there's basically this big inventory sitting on the ocean at the moment. And so maybe that'll slow down, or quite possibly, I think that'll slow down the other side. Spoken about that whole bullwhip effect as the inventory fades, but it doesn't look like it's happening for probably at least a couple of months, I would think, until we're there. So that's that one. That's still going to keep going, and that's affecting inflation. The other one I wanted to jump to was. You can see this European natural gas. Have I got that up on screen?
You've got the Los Angeles one up still at the moment.
Oh, okay. I might need to jump back and reshare that. Stop sharing and share that one. Okay, is that better?
Yep, that's come up now.
Yeah. So I wanted to talk. So gas prices in the US, in Europe have been off the hook, and when you and there's been this shortage of gas in terms of the supply. They haven't been filling as much as they usually do before winter, and that's leads through to higher gas prices. That puts up gas prices in Asia as well. It brings up coal prices because effectively coal and gas are your two options really in terms of producing energy, and so they do feed off each other. We've had some issues with all the extra production in China has been an issue as well, but let's stick with Europe for the moment. And so you can sort of see that what I've got here is this chart showing the 5-year maximums of gas going into Europe, and then the 5-year minimums. And so you can see it's sort of like sitting middle of the pack. It's actually getting pretty close to the highs at the moment. So it hasn't been, we haven't been filling as much as in the past, but the actual flows have been reasonable. If you look at Russia, you can see Russia's off the bottom. So they're basically as low as they've been. Yeah, they were well below their 5-year average. They're still sitting below the 5-year lows, still sitting below the 5-year lows. You go somewhere like Norway. Norway's going full tilt at the moment. You look at LNG. LNG was not quite as high as it has been, but it's running sort of at quite high levels. Algeria is not that big, but it's sort of running at reasonable levels as well. If you look then at the so you go, okay, Russia was where the real problems are. So if you actually look and say, well, what's going on in Russia? Well, the Nord Stream, which is one of their biggest ones, and this is a Nord Stream 1, so the one that is up and running. They're trying to get the Nord Stream 2 up and running at the moment. That's running full tilt. So that's like they couldn't fit another sort of molecule of gas down that line. If you look at the Turk Stream, which is one that's sort of similar, it goes through Turkey, but it goes across the sea as well, so they don't have to pay all the royalties. That's only been up and running for 2 years, but that's basically doing more gas than it's ever done, and sort of more than double what it did last year at this time. The issue is you look at Ukraine, and they're running well below what they've ever done before. And you look at the stuff they're doing through Poland, and it's like chalk and cheese. So it's political, I guess is where I'm getting to with this. As painting the story, you can look at it in any number of other ways. There's other ones about the gas storage. So speaking about how they haven't got as much in storage as what they want, and so they're below their sort of 5-year numbers. And so you look and you go, okay, that looks pretty bad. And then if you look at, well, what about Gazprom, which is the big Russian producer, and you can see they're like, so usually they've got 6 billion cubic meters, and now they're looking at they've got sort of closer to 1. And so it's pretty clearly political in terms of how it's being approached. So what does that mean though? Well, that means it could stay high for a long time. We really don't have what's the at what stage does it come back? They're trying to get Gazprom 2. Sorry, not Gazprom 2. They're trying to get Nord Stream 2 approved now, and they're basically putting the Germans across. I guess they're basically showing the Germans how much power they have in terms of pricing. The Germans have flipped around and basically said, well, we're not going to make a decision over the next 6 months. So they sort of kicked it away, and they're sort of pushing back against this. And I think as a long-term strategy, it doesn't sound like a good long-term strategy to me. I think you want the Germans to know, yes, we've got pricing pressure and all that type of stuff, but you don't want to make it so bad that they need to start talking about getting nuclear back up and running, or be it more LNG imports, or much more investment in renewables. And I think it has gone too far. But we have another. We have winter to get through, and if it is a particularly cold winter, then those prices could really rocket. And so it's an area where that's basically an added tax on the European consumer now. That right through winter they're going to be paying more than a lot more than what they usually do for heating. Yep. And so there's obviously political problems that come with that. There's inflationary problems, but the flip side is they're not a sort of a good inflation problem. This is the bad inflation type problem and these are the ones that get stripped out of the baseline numbers because it's effectively an extra tax. I had to spend 200 euros more on my heating bill this month than what I usually do. Well, that comes out of my expenditure. I'm not going out to restaurants as much. I'm not buying that extra buying those extra goods, and so it is an extra tax. So,
and just on that, the UK has just done some work on forward-looking energy prices, right? And they've just come out and said energy prices could be up 50% over the next year, right? And in the embedded energy prices in the UK, there's about £200 per average household relating specifically to the environment and in renewables investments, right? So they've got this huge slug of tax, which it is a tax, it's a hidden tax, but it's actually a tax, right? Sitting now on a huge price for energy. And in fact, a number of people in the UK that I've spoken to recently said it's probably one of the most fragile parts of the UK economy because it's so dependent on energy and specifically different types of energy in the mix, depending on, they haven't had much wind quite recently. So some of those renewables not doing what they expected, right? So they're having to fall back to gas. And in fact, they've even lifted the coal production to try and actually meet the immediate short term. So you can see how all these tensions are actually playing out in practice. But unfortunately, the households are picking up the bill. Yeah,
absolutely. And so I do think it's all short term, though. And I think that's probably the key message as well from those is that, we look at those solar plus battery costs is sort of the key thing for us is that's your ultimately scalable, technology. Now, solar resources in the UK aren't very good. Well,
for obvious reasons.
For obvious reasons, yeah, that's right. But they are good across most of Southern Europe.
Yes.
And if Southern Europe isn't using, if they're using solar and batteries or wind and batteries, then that means there's the other technology can be done further north and things like that. But those costs are coming down. They're not yet at the cost where it is transferable. But all these really high prices mean it's coming faster because now it's one thing to say when gas prices are $3 an MMBTU that you can buy for in the US and you used to be able to buy for in Australia, or you can in WA, say, then it's much harder to get these renewable projects up and running. But when you're talking about $30 or $60 that some of these these prices have been spiking to, then all of a sudden renewables are actually a much and in our view that price isn't going to spike. Like that's those battery costs are coming down year after year. The any issues in terms of lithium and other minerals and all that type of thing is not really affecting that's just slowing how fast the prices are falling, as opposed to actually creating price rises in that area. Solar panels just keep falling year after year. It's a technology, the more we produce of it, and so our sort of medium term outlook is actually pretty good. The short term outlook is pretty dire in terms of where things could go if you got a poor wind resources and a cold winter, and Russia sort of intransigent on the gas prices. Then you could really see some massive prices and disruptions and political issues. The flip side is you have a mild winter, you get the wind resources pick up again, and Russia decides, okay, everyone's got the message now. Now we want to make sure that we want to keep prices low enough that they don't turn to massive renewable projects to try and get away from Russia. Then it's a much better outlook. So there's one more of these titanic forces that are all sort of coming together and hitting, and which way it goes, you could paint an exceptionally rosy picture if you line up every glass that's going to be half full, and you can end up with a terrible outcome if every glass comes in half empty. And so and so I think for us it's really trying to navigate this and try and work out which are the ones where, and as we think energy prices get too high, is like, okay, well we're lightening up on the energy stocks. As we think travel stocks are getting too low, okay, we're adding a little bit more on the travel side, and just really trying to lean into those to where we go, well, we're not going to try and pick the top and the bottom, but we can see where, say an Omicron, it's going to look really, really bad for a few months, but we think there's a reasonable chance that there's light at the end of that tunnel, and so travel, there's benefits there. And on the flip side, as an energy producer, things might look fantastic over the next few months if Russia continues to do weird stuff, but the valuations just seem to be too high, and similar with the iron ore guys and what's happening in China, the prices just seem too high. So we're sort of taking the other side of that bet and just waiting for prices to fall back.
And it's interesting because some would say the markets are pretty much priced for perfection at the moment, so they're going with the rosy view of the world rather than the slightly wobbly view of the world, or that we saw a few days ago. Markets came down, now they're back up again, so we'll see. But you mentioned China, and I think we should just pause and think about China, right? Because the China question is, I think, going to be the question for 2022. Looking at what's going on, looking at the property sector over there, looking at Evergrande and the other hangers-on. It seems to me that the sort of people in charge in China are trying to protect the domestic investors and the domestic people who expect to get house prices may coming down a bit, but they're less worried about the international fallout. And that's my read at the moment, but I'm not sure whether that's the complete story.
Yeah, I mean, I think it's worth just remembering as well. Every housing boom's got its similarities, but its differences as well. Is that we had in Australia, it's been largely a consumer-driven boom, and similar within the US. What we saw in terms of the US and places like Europe was this huge debt-driven, people throwing money into the housing market and sort of pushing house prices up. In China, there has been some debt at the consumer level, but actually most of the debt's been bundled up into these developers. And the Chinese development sector is where, that's sort of the epicenter of that boom. And so, and to put in perspective, if you add up all the big listed developers in China, and then you add up the big listed developers throughout the rest of the world, the Chinese ones are still bigger than the rest of the world put together. and this is for a population that isn't growing. It's not a growth. Yes, there's been transfer to cities, but that's slowing down now. That's sort of come out. We're reaching the end of that. So that's where the problems are within, and we need to be sort of most careful about that. So the issue then for China is saying, how do you bring down that over bloated sector without crashing your entire housing market? Because household ownership is in the high 80s or low 90s, I think, in China, which is sort of well above most other countries. And so, if you do have a big housing price crash, that's going to that could really damage your economy, because so many people have so much wealth tied up in it. So they're trying to walk this tightrope of going, okay, and they know they've built way too many houses. So they've built way too many houses and mainly apartments. And that's why these property trusts, property developers have got so big. So they want to deflate that sector without bringing the rest of the housing market down. And so and without bringing the rest of the economy down, because the size of the housing sector in China is sort of double or triple what most other economies are, what you see in most other economies. And so it's this line about how do we bail out, and what I see them doing is doing as much as they can to bail out companies and help industrial companies in sort of in areas so that they can keep employing people, so that as things slow down, they've got somewhere to go. That as your workers stop going out and building, you stop having 30% of your economy based on the real estate sector, and you go back to 10 or 15, that those workers have got somewhere to go. And so that seems to be what they're trying to do. Having said that, if things get too bad, I do think they'll stamp on that debt accelerator again and just say, okay, well, yes, we know we want to we know we need to transition away, but we also know we need to keep everyone employed and keep everyone happy. So, we can push that problem off for another year. But I don't think they're there yet, and I don't think they've shown any signs really of all the announcements have been very much along that view about just try and contain the problem and keep the rest of the economy ticking over while we're seeing those issues.
Yeah, and the question there, of course, is they've already reduced further the capital that the banks are required to hold to try and actually allow a little bit more of the liquidity to flow through into the system. So you wonder how much further they can do that.
Yeah, well, and you've got, there's obviously issues as well at if you were a sort of middle level banking executive at one of these banks, you get some pretty different directives sort of coming out. You're saying, well, do I want to be the person who's giving Evergrande the money if Evergrande's going to fall over? And I can see all these projects not working and all that type of stuff. And so, am I going to get, and for some of them, the consequences are, imprisonment and potentially, for some of the more senior ones, there are people who get executed at some of these places. There was a guy who embezzlement in some of the bad debt companies who was executed. And so you're a senior executive of some of these. You've got to think pretty carefully about, am I in a year's time, am I going to be lined up against the wall for putting money into Evergrande when it was clear that this thing was insolvent, or am I going to get lined up for not putting money into Evergrande because people are telling me I need to keep the economy alive, and so and Evergrande is just the tip of the iceberg. There's 7/8 of that iceberg is still underwater there. And so, so there's it's a very tough question, and I would, my guess would be that the bank execs will try to do as little as possible in either direction. This is basically try and steer a path of, okay, I just don't want to get, I don't want the dire cases on either side.
Yeah. Absolutely, and there probably will be a bit of reconstruction and a bit of rejiggering and a bit of reorganisation, but that doesn't solve the fundamental problem, does it?
No, and that's and keeping in mind, it's the building, it's the amount of building that's been going on, and so I've got a few slides up, a few posts we've done in the past, but that real issue is, can you keep building? Sort of, on my numbers, the starts I think are running still at about 1.7 times the number of new household formations in China. So 70% more houses still being started, and that numbers has been crashing, but it could still fall. It could halve, and you're still sort of back at the point where you're like, okay, well maybe that's, maybe it's a more reasonable number. And there's this massive inventory of overbuilt. And when 90% of your, that other thing I was saying, when 90% of your population already owns their house, you've got to, who are you selling to? Yeah. You have to sell to somebody who's moving from a village to a big city centre and is effectively going to leave that house empty, or leave a parent or something in it and move to the big ones, or you're trying to, you've got that very small group of first home buyers you're all trying to hit up.
Absolutely. Yeah. Well, if you think about that, and then if you think about the relationship between China and Australia, right, and some of the tensions there, we're still seeing those political tensions. So, the Australian government has great difficulty talking to the Chinese government. We're seeing continued pressure on certain export categories and extra hurdles being put in place. But it looks to me as though some of the coal stuff might be a little easier and some of the iron ore stuff perhaps a little bit better than it was. But there are some significant pressures and cracks appearing, it seems to me, based on what's happening in China, on the Australian economy over the next year or so.
Yeah, and coal is a great example of this, where 6 months ago you couldn't there was all these Australian coal ships sitting off the coast of China. There wasn't an official embargo, but they weren't allowed to unload their coal. And then we had this massive industrial boom where all these goods that the US is ordering being made in China, needs all this electricity. Plus, there was a few other things going on in terms of some coal problems coming through from Russia as well, and gas prices booming and all that stuff. And all of a sudden, there's an energy crisis going on in China, to which they've responded with not only shutting down a bunch of industries, but also starting up a whole bunch more coal. Now, China's got more coal than anyone. China's got more coal than Australia, but they haven't got, it's getting those operations going. And so you just wonder whether that's just one more of these bullwhip effects where, we've seen extra coal brought on, and then when things do normalize and that goods sort of comes back and you don't have as much industrial production, is that China's actually already started up a lot of this coal production internally and fast forwarding as many projects as they can and banning Bitcoin and doing what they can to try and bring electricity consumption down. Is that it's not a good long-term effect for Australian coal. There's a short-term positive, but the longer-term story, best cure for higher commodity prices is higher commodity prices, and people are looking for alternative ways to get around these. And I think we saw Fortescue's teamed up with I can't remember which company it was, Origin, I think, for the big battery and a massive solar farm, sitting in, and that's this is one of our big mining companies is taken that to solar plus batteries, and that's just I think it's 100 million litres of diesel a year that's no longer produced, and each one, as every time we see these spike in prices, more and more companies will make those same decisions about, and more countries will make those same decisions of, okay, yes, if I've got solar plus batteries, I've got, there are some issues and things like that, but I'm not sitting here worried about production lines. I'm not here worried about spikes in prices and all of a sudden facing double the energy costs that I might have faced. And so at exactly the wrong time. So I've spent the money, I've locked that in. That's now a cost that is sort of embedded in that business.
Absolutely. Now, let's just shift the conversation forward, because one of the things, of course, this last year is a lot of the investment banks have actually had a really good year. They've had a really good year because of all the fees from all the trading, but also a lot of M&A and mergers and takeovers and restructurings and all those sorts of things, right? And in fact, if you look at Macquarie, for example, their share price is pretty much as high as it's ever been. So I guess there's an interesting question there. And Master Singleton asked this about Johnson & Johnson, the recent plans to split into two publicly listed or traded companies. BHP is doing some restructuring and basically slicing and dicing what they're doing. What's your sense? Is this a really important development in terms of actually, the restructuring, and how does that flow into the investment banking sector?
Yeah, as a broad brush. Now, this is certainly not true everywhere, but it's I guess it's across the industry. Mergers and acquisitions tend to be very profitable for investment banks and often not as good for the actual companies involved themselves.
Yes.
It's when you're splitting companies, often actually appears in the opposite direction. Actually, it appears that the companies that get spun out, in particular, get a bit more chance to. Often they're a third wheel, so to speak, in the company, or so they didn't maybe a little bit capital or strategically underappreciated, and so often when they get out by themselves, they can actually create more value. Now, I just wanted to say though as well, and highlight in a huge disclaimer, is there's a very broad outcome. Yep. There are some fantastic acquisitions that get made, and there are some terrible spin-offs that happen where the thing gets spun out and it's shoved in a life raft, and next thing you know, it's sinking. It's on its own. So not every single one of them is going to work, but a good year for investment banks doesn't fill me with hope that it's a good year for the rest of the rest of the economy, and there's more going on, and there's more productivity gains. I don't think there's a lot of correlation between those two, and I'd argue very strongly against the causation. in terms of Johnson & Johnson, that's one sits within our portfolio. Johnson & Johnson's interesting in that it's actually such a it's almost a bit like a healthcare ETF in a way. It's sort of got so many fingers in so many pies. It was really like this big diversified health company that just stretches right across the spectrum. And so within, I can see some benefits for it. I'm not particularly, I'm not particularly in love with either of them. I liked the combination at the prices we could buy them at, and it was such a diversified holding. Once they're separated, it'll be more about the pricing between the two and how we look at it. But I do sort of try and give companies that are being spun out a little bit of the benefit of the doubt, in that quite often, being on their own does sort of help to spur that statistically they generally do better.
Yes. But you're right about who wins. It seems to me that quite often it's the investment banks who win in these restructurings, and of course they have teams looking for opportunities, right, to break things apart or put things together. I actually know a number of people who work in those areas, and they have huge bonuses when they're successful. And sometimes, if you look back 2 or 3 years later, you realise that actually the shareholders really didn't get a huge amount of benefit out of the back of it. And quite often, when you actually are acquiring, and I worked for one of the big banks in Australia whose growth strategy was to acquire other businesses around the world. 5 years later, they divested them all because they realised actually it wasn't a good strategy. So they lost huge amounts of money, and in fact, their share price is still lower than it was when I used to have options in them years and years ago. So there's an object lesson there.
There are plenty of ones like a CEO comes in and we're all headed in this direction, goes out and buys 6 companies, and hopefully somebody behind's banging them together properly, and then finds out he wasn't, and then he loses his job, and the next person comes in and clears we're back to basics and clears everything out. And then the next CEO comes on and we're headed in this direction now, so then buys a whole bunch more companies. Yeah, that's
Well, I can remember, seeing the CEOs come through every few years, and you're right. You sort of, marching off down this way, and there'll be a squeal of the brakes. There would be, of course, writing off a bunch of stuff with write-downs at the start of the process, right? And you always have these adjusted returns rather than actually the real returns.
Yes.
So oh no, this isn't core business. This is stuff over there, right? And then they go off down a different avenue. I mean, CBA is a classic example, right? They had a big go in the UK and then basically pulled back from that, and NAB's a bit the same, right? It is a really interesting psychology here of new CEOs wanting to come in and leave a stamp and point in a different direction. Almost any different direction is good, except it's not for shareholders necessarily.
No, that's right. I've got a post up from a couple of years ago on, just showing how, as a discounted cash flow, which is a pretty common measure for anyone who's not, it's a way of doing valuations. I've got there, and I've got a table where I show how you can double or halve a valuation by changing everything in the second decimal place where you can't even see it. So you go from, you just tick because there's like 7 assumptions that go into it. You go, there's a beta, and there's a risk-free rate, there's inflation rate, and there's a market risk premium, and you just sort of go, okay, well, I'll make it, for this one I'll make it 5.54, and for this one I'll make it 5. I'll go the other way. So when you round it, you can't even see the difference, but you can double or halve your valuation, and then you go into all make the adjustments. As soon as you start seeing adjusted numbers, it's the number of things that people put, like what was WeWork had some great ones. They were like community adjusted EBITDA, which was basically we've just stripped out every cost we can possibly find. And there's one company that was, I think it was WeWork, that was doing they'd give a discount on the rent, and then they wouldn't include that. They'd include the sales. So they'd basically say, okay, Martin, I'm going to lease this floor to you for $10,000 a month, but I'm going to give you a 50% discount. And so they report their sales as $10,000. even though you're only paying them $5,000 in rent. But they were saying, then they were like saying, oh, well, that's a commission back or whatever it is, so that their other levels, their revenue numbers would look higher. And yeah, anyway, there's 101 sort of ways to play those. So yeah, it's. I'll recommend. I'll get a link for you for that one because it's.
We'll post it in the comments below. It'll be very interesting, and it's a perennial, right? And it's the management consulting companies and it's the investment banks who make all of the play, and everybody else picks up the pieces. Now here's one from Jason, which is sort of just on the same theme. Which is the most shorted bank of our big four? Last time I looked, it was Westpac, but I haven't looked for a couple of weeks. I've been rather busy.
Yeah, I'm not sure. Usually it's Westpac. Yeah, that's it's interesting. It's sort of that with all these questions as well. The amount of shorting is a very interesting one. In that, my take on shorting is that what matters is the level of shorting, but also the direction. And so there are times where companies become so short that there's actually there's nowhere else for them to go. And each sort of company, I feel as if it's got its own sort of natural level of what its shorting is. So for some company, that might be 10% of the stock. And for other ones, that might be 15% or 5%. And so, so it's a matter of saying for this stock, a 5% short level is actually really extreme, whereas for this other one, 15% is really extreme. So that's one part. But then the other thing is, it's as it's moving up. So if you've got the company that as it's moving from being 12% short to 15% short, you can see the stock price falling. But at 15% short, there's nothing left out there to short anymore. And if you get any positive news, these guys all of a sudden have to buy it back, and you start seeing that sort of coming in. And so it's a matter of trying to play both of those to try and work out the which is the most important.
Yeah, and Vanessa made an interesting point. I thought our banks were insured by the government. Well, basically, the way that the market looks at our big four banks in particular is that they are basically, supported by the government. It's not necessarily an explicit guarantee that's written on a piece of paper, but philosophically, the ratings of the banks are tied to the ratings of the country, aren't they? Yes,
absolutely. But I guess in the end, if you're worried about whether the banks are going to go under or not, equities is definitely not the place to be. So I think equity investors, that's sort of a nice to have a bit of a fallback, but in the end, it's a bet on whether whether the housing market keeps going and people keep borrowing money.
Yep.
Really.
Yep.
There's not a lot. If the housing market turns, then the banks are in trouble. I think there's certainly it's a bit of a play on yield curves as well. Well, that's actually just as much as anywhere. The issue I look at for the Aussie banks, and I'm still not quite sure the answer is, but I suspect I know it. I don't think I like it. Is that when you get a flat yield curve, banks stop making money. So, which is what we've seen in Europe, because effectively they're lending out at a long term and borrowing at a shorter term. So you're lending out for 25 years and you're borrowing at sort of 3 to 5 years in terms of from others. And so in Europe, they got to the stage where banks there were so unprofitable, and a lot of them are state owned, that we've got these programs for the ECB to try and keep them profitable by effectively transferring very cheap money across them. We saw that for a little bit in Australia. And it's this issue that you say to go, okay, well, what that really means is you don't, when you get these flat yield curves, you want to keep it flat so that you're stimulating the economy, but you don't want to send your banks broke, because then that's not going to help stimulate your economy. And so they're basically trying to keep in Europe, they're trying to keep the banks with a certain amount of profitability, so they'll go out and lend money. And then so there's a long way of getting here, but the issue then in Australia is saying, well, if that means it's that the Australian banks are effectively in a similar position, getting this cheap funding from a few different sources that we've sort of seen come out over the last 6 or 12 months, is that if the Australian banks are actually just really close with the regulators and really chummy, then maybe that just means the regulators will keep them more profitable than what you might see in the European banks.
Yep. Well, that's a consistent story here in Australia, as you know. If you look at the average margins of our banks compared with the European or even the US banks, they have always been much more profitable. And of course, the RBA handed over that really, really cheap money, term funding facility, to continue to allow that to happen, which is quite remarkable.
Plus, there was the other one they wound up recently where, I've got a mental blank on the name of it, where basically because of the government bond, they put it in like 10 years ago.
Committed liquidity facility, right? We're talking about.
It was one where they could basically, instead of getting government bonds, they could buy each other's stock.
Correct.
And so they're all giving each other cheap funding.
Yep.
In order to,
it's all that dance of everybody else saying, "Yeah, we're all in together, not a problem. We'll just fund each other's."
But it's really complicated. How can you completely? Who's going to stand out the front of Martin Place or whatever and campaign against that? Stop the committed loan facility.
I know.
No, it's hard to understand. So because it's so hard to understand, it's like, well,
but you got to understand, it's deliberately made hard to understand, right? It's not actually complicated, right? It's basically everybody borrowing each other's paper so that basically everybody's winning. Well, everybody, the banks are winning, right? And we need a strong financial stability mandate, and we need strong banks, and we want them to be really profitable, etc., right? Unfortunately, that means that you and me and anybody borrowing is probably paying more than they should, and depositors are paying, not receiving much less than they should, because the banking system is, frankly, cruelled by these horrible structural relationships, and then the regulators are sitting over the top and do nothing. So that's the corner, short corner discussion as to what's going on with the banking system.
And so here's the problem for Aussie investors, and myself included, is banks are expensive. Like the Aussie banks are some of the most expensive banks in the world. We've got problems with, we think anyway, is that I think Leith came on talking about the next another lost decade.
Yep.
But we think Australia, there's a solid reason, and the fall in China, there's a solid reason for rates to be lower in Australia than elsewhere. And so from a macroeconomic view, you look at these things going the most expensive in the world. They're making all this money they probably shouldn't be making. Rates are, we've got these short-term rates rising, housing market potentially a bit weaker. They, from a macroeconomic setup, they've got a lot of red marks against them. The flip side is, if the government and central banks and APRA want to keep giving them cheap money to keep funding the housing market, to keep
our money,
over,
they're giving them our money.
Yeah, then they will.
Taxpayers' money.
So So if it's so what do you do? Do you buy them because you'll get you're effectively betting on a bailout, or do you go with the macroeconomic view and avoid them? And
that, of course, that's why the bail-in, bail-out conversation is so important, right? And the underlying view I still have is that they are a protected species in Australia, and governments and central banks and regulators will do whatever it takes to keep them in play. If they're small organisations, they might get sucked up, a bit like Bank West got sucked up by CBA. But the big ones, they're probably more protected than almost any other entity. Well, maybe than some of the miners. But it is, once you start understanding how this stuff is working, you realise just how much taxpayers' money is going directly and indirectly to support our banking system, right? Yep. And then the question is, have we got a fit-for-purpose banking system, and is it doing the right thing for businesses and for consumers? And the answer is no, but never mind, nobody worries about that because the banks are still super profitable.
Yeah, and that's the part where, for me, it's about saying, well, I don't mind the idea of saying, okay, we want to make sure this banking system doesn't go bust, because when a banking system goes bust, really bad things can happen to economies, and you lose that whole trust and stuff like that. So I don't have a problem with that per se, but I do think if you've invested in these banks, so it's about saying you want to keep the lending facilities going and the banks ticking over, but you don't want the shareholders to make out like bandits because of it, and you don't want the debt holders, if you've run into problems, basically go, I can lend to this thing at any price because who cares? I'm going to get my money back. You need to see that that debt holders take some sort of pain, and equity holders absolutely should take some pain if they make the wrong investments. And so that, I guess that's where I'm coming from, is that, look, it's about, I think there's Australian regulators have crossed too far into we need to make sure these things don't fall over, so therefore let's make them super profitable.
Well, and they also argued it's better to have a smaller number rather than a large number because it's easier to supervise them.
Yeah, I know. It's the same thing with super funds, though, isn't it? Like, it's the same. It's this thing about super funds where, they're actively trying to reduce the number of super funds to increase competition.
No.
It's too high, and you're like, what other sector says, fees are too high, we need to increase competition, let's make monopolies, let's start making things together.
But it's the same argument. They want a smaller number of bigger players, right? Because it's easier to supervise. That's the real issue, right? And that's, again, that our regulators are so lazy and are so captured that they just cannot stand back and think about this objectively. They're just caught within that sort of wave of... so it's a similar trend, just a different bit in the cycle. It's where the banks were 10 years ago or something like that. We're running sort of time, but there's one other question. Magellan, of course, there was a big sort of move in the share price, and they lost one of their big investors. Any thought on that? Is it significant, not significant? How are you reading it?
Yeah, look, it's a tough one. I think look, I mean, I think with any of them, it's worth noting that they have a quality focus, which is similar to us. So I have some sympathy in terms of that focus. They're very concentrated. So they sort of run a 25-ish stock portfolio on, can't remember what their latest fund, but it's tens of billions of dollars. Like they're one of the biggest shareholders in a lot of the things they own. So it's actually quite hard for them to move that around. So, and then the other thing is that they've sort of looked upon China as being an opportunity to invest, whereas we've sort of looked upon the opposite direction and say, well, I sort of take a fundamental view that I think there's much bigger forces going on there, and it's not somewhere I want to be invested. So the question now with a lot of these companies is, can they reverse what they're doing? And I think they've got, can they turn it around from where they are? And I don't think they can turn it around quickly. I think there's performance takes time to build up, and they've sort of had a rough trot. And when you get some bad headlines, it can take a while before you you get some performance, and then you get the positive sort of flowing back, and the fund flows come in. So I do think they don't tend to be short term. Lots of money in this month, lots of money out next month. It sort of tends to be, once you're getting money flowing in, then money will flow in for weeks and months and 6, 12 years after that. Once it starts flowing out, I think it can take, it can go through a reasonable cycle of flowing out before it turns around. Having said that, the institutional funds they're the ones that are very, they are jumpy, and that they can obviously pull out big amounts of money very quickly. They are the lowest fee, so the fees on those are dramatically lower than say the retail fees. I think Magellan charges 1.5% plus a performance fee, I think, on some of their funds. So they're up there in terms of the amount. And retail investment ones tend to be a lot slower in terms of moving out. So look, I don't think they're in danger of going bust or whatever. It's not like they've got big debt burdens or whatever, but it doesn't look like one where things will turn around quickly.
AMP is another example, isn't it, where basically the drain of funds out of AMP, it didn't stop quickly. It was sort of over a long period of time, right?
Yeah, and AMP is different in the sense of AMP is so diverse, and to have that many problems across such a diverse industry was such a diverse company was a sign that something was really rotting within the entire thing. Magellan in the end is not a very big company, and it's not a very it's a huge company, but it's not a very big in terms of the number of people working for it, and in terms of the strategies, it's only got a very limited number of strategies with lots of money in it. So the business itself is quite simple, which I guess means things can go wrong quickly and go right quickly as well. And the other part to note is that they have been underperforming in a rising market. So because they've been more conservative, and so and I think some of the China stuff obviously hit them as well. So potentially, if you do get some market ructions, there might be some outperformance coming back in terms of that. But look, I guess the thing is, I run a funds management business myself. So I obviously like, and I'm the biggest investor in my company, so obviously like the idea of funds management companies, and if you run them right, and Magellan has that bit about not that many people, keeps it relatively costs are pretty low, and they earn some fantastic margins there. But the flip side is how much do you want to pay for that, and if funds are flowing out, you need to factor that into how much you're prepared to pay for it.
Yep, fair comment. Now, last question tonight, which is back here. CBA came out with a quite strong growth forecast. I don't know whether you saw it, but what's your perspective on growth over the next year? And what is the sort of the biggest upside risk and downside risk of all of the things that we've touched on?
Yeah, well, the biggest downside is China. I think the biggest. So basically, if China, if it got unruly, if we start to see property price falls, and that turned into people losing faith in the property market, then there's your big downside in terms of China. Whether is that the most likely outcome? No, I think they'll probably manage the glide path. I think, but there's obviously stuff that can go wrong on that. In terms of the upside, it's actually probably China as well. If you got if they basically abandoned their slowdown on the property sector and just kick the can down and say, okay, we'll deal with it another year, then you would see that sort of push the Aussie dollar up. You see all the mining companies go. The government's coffers would be full again of iron ore and coal revenues, and and then off go the housing market. We go back to that old economy where we're just sort of recycling mining profits into houses. So I think I'm just trying to think what other factors could really. I mean, interest rates is if we let interest rates go up too far, but I don't think we're going to do. I think the Fed seems to be more likely to make a mistake than the RBA at the moment. Yep. I think the market in Australia is moving much faster. Is pricing in much more in terms of Australia than what you hear out of the RBA. So I'm putting that to the side because as I said at the start, that is our biggest issue is will there be policy error? But I'm assuming in Australia there won't be. So.
CBA, the RBA will do very little, right?
Yeah,
and they'll do it slowly. Right.
Exactly. And
there's an election in May. They won't do anything before the election, probably.
No, you would think they're not too keen to do anything before then. And the other thing is noting that they, I'm not sure is the full review been announced when the timing of it. But anyway, there's a review coming of the RBA and how they've been missing their target for the last.
Yeah, well, the RBA is arguing that they don't want a full review; they want just a review of the recent policies, right?
Yeah.
Massive misdirection, but another story. Yeah, they won't do much.
The net effect is though, when you're having your homework marked for letting inflation come in too low for too long. stamping out the first sign of inflation probably isn't the first thing on your mind.
Yeah.
So
absolutely.
Yeah.
So I think, folks, to summarise, what we're saying is there's a lot of uncertainty out there. There are things that people can do from an investment perspective to take account of some of that uncertainty, which is what Damien's been going through this evening. And the Nucleus Wealth and Walk the Wealth funds, the philosophy is to build that wealth around the core and to try and position against some of those rather conflicting things that are going on at the moment, which means hopefully there's protection but also potential opportunity. Yeah,
it's about getting that diversification, and so hopefully we're holding that sort of middle core for you, and then around that you can do more exciting stuff or more stable things too, depending on what your what your preferences are.
Well, Damien, I really thank you for your time tonight, and always enjoyed speaking with you. And we'll do it again next month, but it will be 1 month later because of your extended holiday. So have a nice time off, and we'll be comparing notes at the beginning of February as to what's gone on or what's going on. So that should be fun. Thank you very much. And we've put the links and things below to the Walk the Wealth Fund. And if people want to get more information or go across and have a look at what service you offer, they can go across that link. And there's a lot of really good information about what you guys do there. And I'll look forward to picking up the conversation there. And have a great new year.
You too. Thanks, Martin.
Thanks very much. I'm going to take you offline now, and I'll just close out the show. Thanks, Damien. So there we are, folks. That's another show done and dusted. In fact, quite a long show. Just two things I want to say. Just to remind you again that we'll be live streaming Jill's memorial and celebration Thursday, 1:15 onwards. It actually says 1:30 in the invite. Basically, there's 30 minutes of pre-show, and then we go. So feel free to come and join us online. And I'll also just mention the Asbestos Awareness Australia website, which is one we launched after Jill died. It's got a lot of information about asbestos, and we'll be talking more about that later, but that's something else I've been working on in the background too, so just bear that in mind. And I should tell you that in a week's time, I haven't got a thumbnail yet done, but Tony Lacantro will be joining us for the first Tuesday of the new year, and we'll get perspectives from Tony as to what he's seeing and what his thoughts are and how he enjoyed his Christmas and New Year. So thanks all very much. Appreciate all the messages of support from so many people through my recent experiences. I really want to just say thank you to all of you for your messages and your condolences. It is greatly appreciated. We're going to go on making shows because, frankly, that's what we love doing. And I'll look forward to seeing you again soon, and either catch me live next week or one of the pre-recorded shows in the meantime. Have a good evening. Happy New Year. And we'll see you again soon. This is Martin North from Digital Finance Analytics, signing off. Cheerio.